Everyone has heard about the federal funds rate hike, but why was this necessary, and how does this fight inflation? To answer that, we first need to know what the federal funds rate is. The federal funds rate refers to the rate at which commercial banks can borrow or lend their excess reserves to each other overnight. Why would banks do this? Because, by law, banks are required to maintain a reserve equal to a certain percentage of their deposits in an account at a Federal Reserve Bank. Therefore, if a bank does not meet the requirement, they will have to borrow from another bank overnight. So why would the Federal Open Market Committee raise these interest rates and make it more expensive for the banks to borrow money? The short answer is, to slow the economy. This may seem odd at first, but it makes sense in times like these when inflation is extremely high. If you were thinking about getting that brand new car that you've had your eye on for a while, now might not be the best time to pull the trigger. The rise in interest rates will raise costs on home and auto loans, credit cards, business operations, and many other things that are involved in the daily lives of every American. The Fed rising borrowing costs will lower demand, creating less spending. When demand is lowered but supply is the same, costs go down, which lowers CPI, which is often looked at as the main metric for inflation. A slowing economy might not sound good, but it is essential to be aggressive towards lowering inflation when it is so high. If you enjoy our content, don't forget to give us a follow on our other social media platforms. Thanks for watching, and stay informed.